Early retirement is a dream most of us want, but few of us are able to accomplish simply due to poor planning and savings. According to a recent survey from TD Ameritrade, 50% of Americans dream of retiring by 60, yet only 33% believe they'll be able to accomplish that hope because of their current financial portfolio. The median savings account balance among U.S. households today is about $4,800, with 29% of those households having less than $1,000 saved. No wonder early retirement seems like a distant dream. So, let's take a look. After nearly 10 years following the Great Recession, a new survey reveals millennials have no savings amid rising probabilities of an imminent recession. Banking company Borrow Money found that 6 out of 10 millennials don't have $500 to cover their rent or food expenses in the event they lose their jobs in the next downturn. That percentage is slightly higher for millennial women, 65% of whom don't have any savings at all, suggesting when the next economic downturn strikes, they will have no financial cushion, which could send them back to their parents' basement. When it comes to savings for the rest of the deadbeat nation, the picture is equally worse. 5 out of 10 respondents said they didn't have $500 saved. The survey determined that men are more inclined to save than women, 56% of men versus 39% of women. About 45% of all respondents said they don't have a savings account. Among those who have a savings account, 30% said they couldn't correctly define what annual percentage yield, or APY, means. Of those who could define APY, the majority, 56% of all respondents, said their financial situation is much worse than their parents at the same age. Living life is more important than financial well-being for 41% of respondents, followed by 35% who believe saving for an experience was more important than a savings account. Only 24% believe that saving for retirement is essential. Vero Money surveyed 1,200 adults in December 2018 during the bear market in stocks. With millions of millennials and a large swath of America mostly unprepared for the next recession, the slide in living standards for the bottom 90% of Americans will likely continue. Some think they have an answer. Roughly 40% of Americans think winning the lottery would be a good retirement plan, according to a survey from financial company Stash. The idea is even more popular among young workers, with nearly 60% of millennials saying winning the lottery is a reasonable way to prepare for retirement. Have you ever dreamed of becoming an overnight millionaire with the lottery? Well, the odds of winning that much money are shockingly terrible, somewhere around 1 in 300 million for huge jackpots like the Mega Millions or Powerball. Your odds are better trying to be an astronaut, winning an Olympic gold medal, or even giving birth to quintuplets. So, why do so many people think playing the lottery is the best way to prepare for retirement? Probably because for those who are struggling to save anything at all, even the terrible odds of winning seems better than the odds that they'll be able to save enough on their own. For some of you, the answer for retirement is the eighth wonder of the world. The quote often attributed to Albert Einstein is that compound interest is the eighth wonder of the world. Not sure if Einstein said that, but the concept is certainly true. So, when should you start investing? The best answer I can think of is yesterday. That's when. But if you think of it, compound interest can be extremely powerful for investors over time. Compounding interest essentially means interest on interest, and it's why so many long-term investors have been successful. Yes, the investing landscape can be volatile, and periods like December 2018 can make it more difficult, but if you are saving for retirement and have time, One of the best things you can do during periods of market stress is compound interest. This chart from LPL Financial shows an important example. It depicts two hypothetical investments, both assuming an annual return of 8%, which these days may be pretty optimistic, but we'll go with it. In the first scenario, or the blue line, an investor puts away $3,000 a year from the age of 21 until the age of 30, then stops. In the second scenario, which is the yellow line, assume an investor starts to invest $3,000 a year from the age of 31 until the age of 70. Interestingly, the investor who invested only 10 years but started 10 years earlier has more money at age 70 than the investor who put money away for 40 years, simply because the investor started earlier and let compounding interest work its magic. Remember, money can be powerful. For today, that's ChewDog Charts. Thank you.